While billion-dollar AI companies dominate headlines, two U.S.-listed AI stocks are trading at just $2.84 and $1.04. Not $200. Not $50. Under $5. And yet both operate directly inside the AI expansion cycle heading into 2026. Here's the imbalance. Billions are flowing into data infrastructure and enterprise automation. But these micro-cap names are building technology that plugs into that same ecosystem. Now here's the strange part. One built an AI operating layer used across media and public sector workflows. The other turns global regulatory chaos into structured, machine-readable intelligence for enterprises that can't afford compliance mistakes. Different angles. Same macro wave. So why are they still priced like overlooked penny stocks? And what would actually need to happen for either of them to reprice in 2026? Let's start with the $2.84 stock. This company built what it describes as an AI operating system, essentially a layer that allows enterprises to deploy and manage artificial intelligence models across different environments. Instead of building one narrow AI tool, it created a broader infrastructure that can ingest data, process it with machine learning models, and automate workflows. Think media monitoring, content analytics, voice processing, public sector data scanning. It's not flashy consumer AI. It's workflow AI. The kind that runs quietly in the background. Now pause for a second. When AI headlines focus on chatbots and image generators, how many investors are paying attention to back-end workflow engines? That's where asymmetry can sometimes appear. This platform has been used in media environments to analyze audio and video content at scale. It has also expanded into advertising technology and certain public sector applications. In a world where video, audio, and digital content are exploding, tools that can automatically index, search, and monetize that content become increasingly relevant. And here's the subtle angle. As more enterprises adopt AI tools, integration layers become valuable. Companies don't want 10 disconnected AI systems. They want orchestration. Industry-wide, enterprise AI adoption continues to rise, especially in workflow automation and data intelligence. Larger firms dominate headlines, but smaller players often position themselves as flexible integration layers. That creates both opportunity and risk. Opportunity if adoption accelerates. Risk if competition compresses margins. So how does this company make money? Primarily through SaaS-style revenue streams, licensing its AI software platform to clients. Recurring revenue is attractive in theory, especially if customer retention remains stable. The company has worked with media organizations and has positioned its AI layer as a way to unlock value from unstructured data. That's important, because unstructured data, audio, video, regulatory text, represents one of the largest untapped AI opportunities. Now here's the reveal. The $2.84 stock is Veritonic, trading under the ticker VERY. At recent levels around $2.84, it sits firmly in penny stock territory despite operating in the AI software space. Why is it still cheap? Revenue growth fluctuations, profitability concerns, and the volatility that smaller AI firms face in competitive markets. But if enterprise AI spending continues expanding into 2026, small-cap infrastructure players sometimes re-rate faster than expected. That's the tension. Low price. Real AI platform. Execution risk. Now let's shift to the $1.04 stock. This one operates in a very different part of the AI landscape. Instead of media analytics or workflow orchestration, it focuses on regulatory and policy intelligence. Governments produce massive amounts of data, legislation, compliance updates, rule changes. For global enterprises, tracking that information manually is nearly impossible. So what happens when you apply AI to policy chaos? You structure it. You automate tracking. You flag risks before they become problems. Imagine being a multinational company operating across dozens of jurisdictions. A regulatory shift in one region could impact revenue, compliance costs, or product strategy. If AI can scan thousands of policy updates and summarize actionable insights in real time, that's not just convenience, that's risk management. Here's the interesting part. AI adoption isn't only about productivity. It's also about reducing uncertainty. And regulatory intelligence sits directly in that lane. This company monetizes primarily through subscription-based access to its intelligence platforms. Organizations pay for structured data, alerts, and analysis tools. In an era where regulatory complexity continues increasing, especially in tech, AI, data privacy, and global trade, demand for structured policy intelligence may rise alongside AI regulation itself. That creates an unusual loop, AI companies needing AI tools to track AI regulations. Now for the reveal. The $1.04 stock is Fiscal Note Holdings Inc., trading under the ticker note. Recently priced around $1.04, it remains a small-cap name despite operating in the AI-powered regulatory intelligence space. Why is it still priced this low? Similar themes: growth pressures, market skepticism towards smaller SaaS firms, and the broader volatility of micro-cap tech. But here's the angle investors debate. If regulatory complexity expands into 2026, especially around artificial intelligence, platforms that automate policy tracking could become increasingly essential. So now we have two AI penny stocks under $5. Veritone at $2.84, AI operating layer focused on media, advertising, and workflow intelligence. Fiscal Note at $1.04, AI-driven regulatory intelligence platform helping organizations navigate policy risk. Let's compare them directly. In terms of price anchor alone, 1.04 feels psychologically cheaper than 2.84. But price per share isn't value by itself. What matters is adoption speed and scalability. Veritone operates in areas tied to digital content growth and enterprise workflow automation. If content analytics demand accelerates, integration layers can scale quickly, but competition is intense. Fiscal Note operates in regulatory intelligence, a narrower but potentially sticky niche. Compliance tools often have strong retention if embedded deeply into enterprise processes. However, growth may depend heavily on execution and cost management. Risk profiles differ too. A company operating in media and advertising AI may experience revenue volatility tied to broader economic cycles. A company tied to compliance and regulation might experience steadier demand, but slower breakout momentum. Now imagine two scenarios heading into 2026. In one, enterprise AI deployment accelerates rapidly, pushing demand for orchestration platforms. In that case, a $2.84 AI operating system player could see sentiment shift quickly. In another scenario, regulatory scrutiny around AI intensifies globally. Suddenly, platforms that structure and monitor policy risk become mission-critical. A $1.04 regulatory intelligence stock could attract renewed attention. Neither outcome is guaranteed. Both involve execution risk, competition, and market volatility. But the asymmetry is what draws attention. US-listed AI-focused companies trading under $5 while operating in real enterprise segments connected to long-term AI trends. And that's the educational takeaway. When evaluating penny stocks, price alone shouldn't drive the decision. Understanding the technology, revenue model, industry positioning, and risk exposure matters far more. Low share price can signal opportunity, or it can reflect structural challenges. The key is analyzing why the price is where it is. As AI spending continues evolving into 2026, smaller infrastructure and intelligence players will likely experience volatility. Some may struggle. Some may reposition. A few might surprise. The real question isn't whether these two stocks will move big. It's whether their business models can translate AI expansion into durable revenue growth. That's what ultimately determines long-term outcomes.